Good morning and welcome to today's webcast, Not-for-Profit Tax Update from Capitol Hill. Before we begin, here are a few things to keep in mind. For best viewing, close out all other applications and turn up your speaker volume. You may adjust placement and window size using the controls in the top right corner of each window, or expand the slide view by dragging the lower right corner to resize. Ask questions today by entering your questions in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. You may download a PDF copy of today's slides or the group CPE attendance sheet from the slide deck and handouts widget to the right of the slide view. And if you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer within the poll window and click Submit. Today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. If you're attending this webcast in a group, you must complete our group attendance sheet available in the slide deck and handouts widget to receive CPE credit. Please have all group members sign the sheet and please remit only one sheet per group. We'll track your CPE progress today, and when you have earned your CPE credit, you can click the certificate icon in the CPE progress widget to download a PDF file to save to your computer. We'll email a copy of your CPE certificate in 2 weeks if you can't download it today. And as a reminder, today's presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. And I'm happy to introduce today's presenters from Moss Adams. Patty Mayer has practiced public accounting since 1984. She provides tax and related tax planning services with an emphasis on not-for-profit and tribal organizations. Patty works predominantly with public charities, private foundations, and tribal organizations. She is a leader of our Southern California not-for-profit tax practice and a member of our not-for-profit tax committee. Jane Coleman has been in public accounting since 2008. Her focus is providing tax and consulting services to not-for-profit organizations. Her experience includes welfare and benefit plans and taxable trusts. She is a member of the American Institute of Certified Public Accountants and California Society of Certified Public Accountants. And to kick today's presentation off, we're going to start with a polling question. What type of organization are you representing? Association, foundation, healthcare, higher education, not-for-profit organization, a Moss Adams employee, or other. And I'll give everyone a few moments to make a selection. To participate, please click the button next to the answer you choose and click Submit within the poll window. And let's take a look at the results. Patty, I'll pass it to you to get us started.
Great, thank you. Welcome, everybody. So it looks like we have a good variety of different persons on the call, and this is great. A lot of not-for-profit organizations are the highest, but we've got education, healthcare, and foundations close behind. Excellent. So I'd like to go over our agenda. And with the agenda, we're going to be starting off with the state of the IRS, looking at their workforce and examinations, and also current developments as those affect tax-exempt organizations. We're going to be looking at tax issues for colleges and universities, and take a peek at Capitol Hill, what are members and staffers focusing on in 2017. We have a lot of material contained in our slides, and so we're hoping to touch on tax reform. And since that kind of is a moving target these days with all the different things going on, Our slides present kind of what's going on as we know of right now, but it's an ever-changing area. So we'll see how far we get through all this data. Starting off with the IRS is shrinking. If we think about it, not only is the IRS shrinking because of budget cuts, so for example, for year-end 2016, a 4.3% budget cut, about $470 million. The IRS is also losing workforce. A lot of the employees that are working there are ready for retirement. So with people trying to leave, and they had a hold on retirement, but they're letting people leave, there's also been a freeze on hiring. So we've got a couple things going on at the same time. Also, they restored some money for taxpayer service, cybersecurity, and ID theft. And they're looking at another 2% cut for year-end 18 that's being proposed. There is some support to increase funding. But how the IRS is trying to manage all this, less people, knowledge leaving the IRS, what are they going to do? So they're looking at automation, analytics, data-driven approaches to find out high-risk areas. So it's really, a lot of it is back to the basis, looking at the data and analyzing the data. Another thing that they've been doing to try to educate all the newer people that are starting while the older people, not older, but the people are retiring, is they've come up with this knowledge management system, and it's to increase technical knowledge. And they also have what they're calling KNets. It's a knowledge network. So they have been preparing and presenting like 3 to 4 live technical events or CPE sessions each quarter. Their knowledge management, they're looking at, they're preparing and posting technical issue snapshots, and these are available for their employees and also for the general public. Right now they have about 6 snapshots, and I'll show you a link later on. But they're looking at things like electronic health records, reasonable cause abatement, who's a disqualified person, things like that. One other big change that we've been noticing, and this was actually brought up by Christy Jacobs. She is the Indian Tribal Director for the IRS, and she made a comment that the IRS used to have what they called frequently asked questions on a certain topic, and it went through all sorts of different scenarios, provided great resources for people to understand things, and practitioners loved it. We love that kind of stuff. Well, they're going away from that. They're looking at more of a short narrative, little snapshot about a topic. And what happens is if you go to that, it may take you to a different area. So you're jumping around within their computer system. And the feedback they were getting is that actually is a preferred method with the newer generations. They like that. They want to just see the topic, move on. Other people like me, we like to analyze things and figure it all out and go really deep. But anyway, so that's kind of where they're going on that. If we look at IRS audits, there has been, this is as of September 30, 16, and you can see there's been 6,440 examinations, and it's driven by different areas of topics. So the main one was verifying, the very top one, filing, organization, and operational issues. So they're really verifying that exempt activities are going on or that the entity is meeting their filing requirements and are there delinquent returns. Those can be triggers. They're looking at discontinued operations and possible revocation. Here again, it's all exemption issues. What are you doing? Have you stopped doing it? The private inurement, private benefit category is the next one. And private inurement, that is looking at insiders. Has something inured to benefit a director, a key employee, somebody, a substantial contributor, somebody that has influence. And private benefit, on the other hand, that is looking at anybody could be getting private benefit, even maybe a contractor that you have to do some sort of building improvement. If they're getting more than market value, that would be a private benefit to that person. So there were a couple hundred in that area. Political, legislative, governance is on there. Unrelated business income, we're going to talk about that a little bit in more depth. I have more slides. But here they're looking at all sorts of things, non-member income, expense allocation, net operating losses, and such. The employment tax issues, that's a pretty big number, almost 1,700. Here they're looking at, they call this and unrelated business income goes into what they call the tax gap for the IRS. It could be unreported compensation, tips, or organizations using accountable plans where things are not taxable to the employee because they've provided the appropriate documentation back to the employer. Worker reclassification between independent contractors and employees, that type of thing, backup withholding, and then there's some other catch-all. The next area is revocations of your exempt status, and here again, there were 61 revocations that happened. The most of them were where they were not operating for an exempt purpose, private annulment going to an insider, and then disqualification of self-declared exempt statuses was one. The one thing in 2013, I pulled this statistic. There were, to give you kind of a perspective, there were 1.4 million exempt organizations that have obtained an exempt status as a public charity, private foundation, or other, and that's by urban.org. So there's a lot of organizations out there, so the IRS is just touching not that many of them if you look at the grand scheme of things. Issues oversight, the Affordable Care Act Schedule H filers, these are your hospitals. They are required to file Schedule H if they're registered and licensed by their state. So you might be a hospital and not have to file Schedule H. There's different criteria, but this is the H filers. They've looked at almost 1,000 of these forms, and a lot of them are coming from referrals for field exam. They're finding out the community health needs assessment isn't being done. They aren't having the correct policies out there, and there's billing and collection requirements that are also not being done. If you look at the exam selection for 990s, 990 Easy, and PFs, they're using this modeling technique. And here again, it's driving the data to try to filter information to find the high-risk areas. So, for example, for the Form 990, their predictive modeling and indicators say, hey, what could be out of compliance? They've developed over 250 queries when you file a Form 990. So example of a query that could cause suspicion to the IRS would be maybe your total revenue reported on page 2 of the Form 990 where you describe your programs, and if there's revenue associated with the program, you list it for the 501c3 filers. That may not reconcile to your statement of revenue, which is at Part 8, Column B. Now keep in mind, page 2 does not show a total. It shows a total for expenditures, but it does not add up all the revenue components. So the IRS is looking at that behind the scenes. So you want to make sure that matches. Another example is lobbying expense. Maybe you have lobbying in your functional expenses reported in Part 9, line 11, but you haven't attached Schedule C, which would be the form to talk about the lobbying that you're doing, and the IRS would be looking for that. Similarly, you might have a transaction reported on Schedule L. Those are transactions with insiders, but you marked under your governance section you do not have a conflict of interest policy. Well, that would raise suspicion to the IRS. It's like, wow, they're doing transactions, but no one is confirming they don't have a conflict of interest. So they'd be concerned about that. or Schedule A is not being prepared correctly. So they're really liking this. As you can see, they've closed 203 returns, and 85% has a change going on from this filtering. They're going to expand it to Forms 5227, which is your split interest trust, and the Form 990T. That's where you report your unrelated business income. And post-determination compliance. That means they've allowed you to be recognized as an exempt organization, but they're coming in to take a peek at you to see if you're doing what you really said you would be doing. One more thing, sorry, I'm going back, before I switch slides. This isn't in your material, but I wanted to mention it. In May of 2017, the IRS started this pilot testing secured messaging, and they call it the TDC Program, Taxpayer Digital Communication. This is huge for the IRS, and it's really, I think most practitioners are pretty excited about it, because right now, if the IRS has questions, it's by mail. They can't accept email if you're trying to work with an agent. They only accept faxes or mail. So they're very back in the times. So with this type of communication electronically, it's hoping that information is exchanged easier, questions are asked, they speed up the examination process. If you can only do this if you're invited by the IRS, and they're doing it right now with Schedule A examinations, and it's working really well. If you are invited, you would need to register with an IRS secured access system. So that's actually good news that the IRS is doing that. Issues oversight for post-determinations. What this is relating to is they examined 1,400 of Forms 1023 or 1024 that were streamlined process. What those forms are, that's your application to be recognized as an exempt entity. The 501c3s do the 1023, all others do the 1024. Well, streamlined process means you've submitted an application and you've addressed every area the IRS has asked about. You have all the appropriate attachments and you have appropriate responses. So it can go through the first bucket of, this is a complete application, pretty straightforward, we like it. Not a lot of questions. So since they've speeded it up, they wanted to take a look at, well, how good are we doing by speeding it up? And they had 58% no change, 42% they really wanted maybe some amendments to some organizational documents, or the organizations weren't filing returns. And they had 5 revocations or terminations. The Form 1023, on the other hand, this one's kind of interesting. Form 1023 is only about a couple years old. It's a 3-page electronic filing that you submit with the IRS to become exempt. Keep in mind, however, the instructions are 21 pages, and there's an 11-page checklist to see if you qualify to submit this 3-page form. So start with the checklist if you're thinking about doing this to make sure you can even do it. It mainly is looking at small organizations where you're projecting gross receipts will be under $50,000. Your assets are under $250,000. So start with that if you're going to want to use it. It really just is asking bare minimum information, name, address, who are your officers, what type of organization are you, do you have a charitable purpose, check the box. There's a lot of check the box. You have no private benefit or lobbying, what's your foundation type, and is it for a reinstatement? So they're not asking you to explain what your exempt purpose is, what you're going to be doing, and they're not looking at your organizational documents. Well, those 2 comments raise concern for a lot of private foundations aren't real happy. Well, they're not happy. They just are more, they're more conservative. They really want to watch this because an organization that gets exempt status from a 1023-EZ, they're used to possibly looking at the full application. They can read about what the exempt purposes. They have more trust in the organization a lot of the times. I was at a private foundation conference for the AICPA a couple weeks ago, and a lot of the private foundations had high concerns about the 1023-EZ filings. The other area of concern for a lot of practitioners in advising their clients is when you tell the IRS what your exempt purpose is, you've given them a roadmap that they've approved, and it helps you analyze if you have unrelated business income or not. Is it substantially related to your exempt purpose or not? So without that, the IRS hasn't really seen anything. So although it sounds really great, you'll really want to decide if it's really the best thing you should be doing. If we look at current developments with the IRS, they have a work plan, and in their work plan, it's kind of interesting because a lot of these topics keep rolling over. They look at things as more year-long projects, multi-years, not just one. But again, they're looking at exempt purpose, protection of assets, for self-dealing, some private enormous benefit. International, the IRS is really concerned because they don't have control once the money leaves the United States. So they want to make sure that foreign bank account filings are being done, there's oversight, that type of thing. Tax gap, we discussed that a little bit earlier. Unemployment taxes, UBID, and then emerging issues like the 501R and non-exempt charitable trusts. 501R relates to additional requirements for hospitals and community needs assessment. So that does not apply to everybody. So compliance reviews and checks and correspondence audits, that first part, that's where they're sending out questionnaires or they may ask about a certain thing. Field exams, they're coming out to look at you. But they're finding high risk of private enormous and benefit and also looking at the 990 returns with things detected. Also, so the work plan for unrelated business income that they're focusing on, now this is, an unrelated business is a trade or business that's regularly carried on and is not related to your exempt purpose. If you fail one of those prongs, it would not be unrelated business income. So do you have a profit motive? Do you conduct this regularly in a commercial manner? Or is what you're doing really part of your exempt purpose? So they're looking at these type of things: gaming, non-member income, expense allocation, NOLs, rentals, debt financing, and investment income. This is K1 partnership pass-through items that could be unrelated business income. And I actually even have one of those for a pension plan that the IRS was inquiring why the pension plan was not reporting unrelated business income. So they are looking at this. So they're getting more sophisticated. We got to keep that in mind. If we look at some of the current developments with UBID, some cases, one case was the Community College of Desert Alumni Association, and they were arguing that services were not provided to the vendors and what they were doing was substantially related. Then another one was a weekly fair done by a charity where operation was substantially related, and they were arguing it contributed importantly to their exempt purpose. And another one, seeking refunds for use of net operating loss on non-member income. If we look at some private letter rulings, now private letter rulings help us with guidance on how the IRS is looking and ruling, but the outcome is only applicable to the entity that submitted the request, so it applies to them only, but helps us in figuring out what the IRS is kind of thinking. So the first one was rental income from real property was held non-taxable and personal property was incidental. So here in this case, 95% of the real property was rented and 5% of personal property, both which were not dependent on the net income or profits of the activity. So when you don't exceed 10% for personal property rent, you're still in a good safe zone. So that was all fine. The next one, technical assistance for social sector organizations, were substantially related. In this private letter ruling, it was a private operating foundation that did an analysis of data on community issues, and they made this neighborhood data available to the public. But they developed a really good expertise in figuring out how to analyze this. They had in-house, but they had just people that knew how to do it. So they decided, it's like, gosh, we should open this up for other organizations and charge a fee. And we'll do a sliding scale. If they can't afford it, we'll give it to them. But if they can, we'll charge them. And it was ruled that their activity was substantially related to its exempt purpose. So that was a good outcome. In the next private letter ruling, it was the operation of a gift and coffee shop that was deemed not unrelated. So this was a good outcome. So here it was a cultural center, and they had gifts. They didn't rule on the items, but the gifts related to their exhibits that you could purchase. But the key on the coffee shop was there weren't external doors leading to the outside, so you could only get to the coffee shop if you were in the center, and there were no outside signs advertising. So within the center, they were saying, oh, take a break, go have some coffee, but they weren't trying to induce the public to come in from outside, like, hey, this is a establishment where you should come have your coffee. So that all worked for them. A couple other ones. This was where UBI was determined because an organization was selling product on its online store, by catalog, and at retail outlets. So they agreed, okay, we are a trade or business, we're regularly carrying it on, but they were trying to say we have research and educational activities, but they said, yeah, but it's really not that closely connected. You were hoping the sales would bring in visitors to a visit center. So they didn't lose exempt status, but they had to pay UBID tax. The next one, they were not treated as an exempt organization. It was a coffee shop that operated in a commercial manner. Even though 100% of their proceeds was going toward charitable use, the origin of the proceeds was a coffee shop. So they said no. Next one, very similar. They really operated a business, printing, selling, distributing T-shirts, even though it had charitable intent on the destination of the funds. The origin was not an exempt function. And then lastly, a food service establishment that was also conducted in a commercial manner was deemed that it was more than insubstantial part of this activity for the exempt purpose, so they said, no, nice try. We're not going to let you have it. Okay, polling question. Emily, that's
all right.
you.
Our second polling question is true or false. The IRS is looking to automation, analytics, and a data-driven approach to target high-risk compliance areas. And your options are true, false, or I don't know. And just a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Make sure you hit submit in the poll window. And I'll give everyone a few more seconds. And here are the results.
All right, very good. Good job, you guys. That's correct. True. Okay, UBI audit issues. On this one, again, they're looking at related and unrelated activities. So what are your exempt purposes? History of losses. So for history of losses, what that means is really your net operating losses. Do you have substantiation? Can you really support it? When the IRS did their college and university report from 2013, it's where they looked at 400 universities through a compliance questionnaire. Then they audited 34 of them. But what they found out is a lot of the organizations did not have proof for their net operating losses, or the activities were not really a trade or business. They didn't have profit motives. So they disallowed about $170 million in losses and net operating losses. The other one is expense allocation for dual-use property. And on this one, examples are in, there's some examples with an AICPA letter that was provided to the IRS in February of this year. And the IRS was really seeking guidance, like how do we allocate direct, indirect expenses if the property is being used partially for exempt purposes and partially for a trade or business. So the guidelines they basically gave was that there needs to be a primary relationship to the activity. There can be direct and indirect costs. Indirects can be fixed and variable. The allocation needs to be reasonable and consistent. Your method of allocation, like for a facility, should be square foot or time. Wages would be time spent. IT office, base it on an allocation of personnel ratio. And then they said they should be able to permit organizations to allocate based on gross revenue to each line of trade or business activity that's going on, and a simplified method for smaller organizations that don't really have the personnel to track everything and dissect it. So they were trying to take a reasonable approach. Other audit areas are controlled payments, entity payments, transfer pricing, that's Section 482. Again, that's how you're allocating your indirects. Pass-through K-1 income, it's a big one, and periodical advertising. On the K-1 UBIT, I also wanted to mention states are really looking at this too now. They're looking at their cuts. So you could have a K-1 that's doing activity in multi-states. You'll want to take a look at it and decide, should you be establishing your net operating loss? Would you rise to the level of owing tax to that state? And you need to decide where you're going to be filing. And states can approach you and say, hey, we think you owe us a return and some tax. So just because you don't file means that they're done with you. Update on tax-exempt bonds. A lot of that, well, first, before I do this, the first comment is they're selected by referrals, past exam, and VCAPs. The VCAP, what that means is it's the Voluntary Closing Agreement Program with the IRS tax-exempt bond folks. And to have favorable treatment if your bond is under examination, you really want to have written bond procedures. If you need help with that, you can shoot us an email and we'll help you with the key components that should be in that. But all of you should have a written policy for this. Well, the referrals, they completed 22 examinations. Private business use of the financed property was an issue. 5% of 501c3 bonds can be used for private activities over the life of the bond. So it could be a 30-year bond, and that's how you determine it. Arbitrage is where you're investing in taxable securities that result in a profit, and you need to, every 5 years, do a computation and pass some of that back over to the government because you had favorable treatment and things like that. So there is movement in tax-exempt bond area, and they're also trying to develop things to help, like market scans, analytical data to look at non-compliance. So similar. IRS update. The first point on this, Social Security and other personal information. Do not put a Social Security number on a 990. It's on GuideStar, and the IRS does not want you to do it. So if you do see any Social Security numbers, make sure you take it off. It's kind of funny because it doesn't ask for a Social Security number anywhere. So it might be in some of the descriptions on Schedule O where it's popping up and people don't realize it was in a memo or something, but make sure that's off. The IRS would like all returns to be e-filed. They would be happy with that. A lot of them are e-filed already, but if you think about it, if you're e-filing, that helps them manipulate data and do their analytics, and they can hone in on compliance issues. Also, there is a reading room, and here's the website. Here's where you can find their training articles and then the snapshots that I mentioned earlier on specific issues, and also administrative and guidance to examiners is on here. So they're looking at some of their snapshots are for charities, retirement plans, state and local governments, and tax-exempt bonds. Updated Form 990 EZ. What this slide is saying is basically the IRS is pretty happy if people are e-filing because it'll trigger an error. If your name changed and they can't identify you, you have to attach your articles, you can't even e-file, or it helps determine errors. And they were noticing EZs filed electronically had 1% of errors compared to 33% error rate for paper filed. So the IRS really likes the e-filing and tricks it can tell you to do. The priority guidance plan, what that is, it's like a wish list on to provide revenue rulings, explain things of the law to help practitioners understand and taxpayers. Well, it's really hard for the IRS to issue guidance when in January of 2017, an executive order was, they call it the 2-for-1, and mandates any new regulation that's going to be issued in the Federal Register. If you add a new one, you have to take away 2. So people don't understand what that means. There's not a lot of guidance. And then on top of it, there's a regulatory freeze pending review. So nothing's moving right now in priority guidance, even though they'd like it to move. But they're looking at things like regulations for employer-provided meals, retirement plans, this 1023 EZ Streamlined Process. Can they provide more guidance on that? The last point here, this Rev Rule 67390, that one really would be nice to get more guidance on this to see how the IRS would look at it. But right now, if you reincorporate in another state, you have to refile for exempt status. So versus the IRS just accepting the same organization, it's just covered under another state. Or if you're changing the type of organization from, say, a C4 to a C3, there's not clarification on that. Allocating expense dual-use facilities, we mentioned that before, some excise taxes, and the last bullet point is management contracts not resulting in private business use. That's for tax-exempt bonds, more guidance. And my last slide here before I pass it over to Jane is due dates have changed. If you are not aware of it, they have. Partnerships, the first line is the original due date, how it used to be, and then now what it is. So second line, so partnerships had to be extended earlier. Corporations, they get a little bit longer. What's interesting at the very bottom of this, foreign bank accounts, the FBAR that can only be filed electronically, they used to be due June 30th, and there was no extension. Well, now they were due April 15th, but there was an automatic extension to October 15th, but nothing had to be requested. You did not have to ask for permission or send in a form. So you're automatically extended. The Form 990 and Form 4720, now we just have to do a one-time extension, which allows 6 months. The W-2s and 3s, instead of being due February 28th, they were due January 31st. And then 1099s for non-employee compensation, like your independent contractors, those were also due January 31st. And so with that, Jane, I'll pass it over to you.
Thanks, Patty. So our third polling question, Emily?
The third question is, the due dates for filing Form 990 for a calendar year organization are 4.5 months after year end, or 5/15, 6 months after year end, or 6/30, 4.5 months after year end, but an extension to 8/15, and then a second extension to 11/15 may be requested, or 4.5 months after year end, or 5/15, and the due date can be extended with one extension to 11/15. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts to the right of the slides, and we will also be sending these after the webcast. And let's take a look at the results. Jane, back to you.
Thanks. So there's been a lot of chatter lately about the rising cost of college education, and Congress has been looking at the role that federal tax policy can play in controlling these costs. The House Ways and Means Subcommittee held hearings to gather data to help find ways to decrease tuition increases, and they have been focusing specifically a lot on the school's endowment activity. The letters were sent to various colleges and universities with questions about the costs to manage these endowment funds, including how the fee arrangements work, how investment income was spent, and how much of the investment return was spent on financial aid. And in December of 2016, a member of President Trump's transition team, Congressman Tom Reed from New York, unveiled a comprehensive plan with the intent to reduce higher education costs for students. There are essentially 3 pieces to this plan. The first piece is called the REDUCE Act, which stands for Reducing Excessive Debt and Unfair Costs of Education. The REDUCE Act requires colleges with endowment funds of more than $1 billion to use at least 25% of their investment gains to reduce tuition costs for middle and working class families. And those who fail to do so will face various penalties, which include a 30% tax on all investment income. And if violations continue, then colleges and universities can face as much as 100% tax on all investment income and or lose their tax-exempt status. According to a recent study done by the National Association of College and University Business Officers, otherwise known as NACUBO, there are about 91 colleges and universities that hold endowment funds of over $1 billion. And currently this proposal defines middle and working class families as those with income below 600% of the poverty line, which is about $146,000 per year for a family of 4. A second piece to Mr. Reed's plan is called the Access Act, which stands for Accountability of College Costs through Exposing School Spending. This act will require schools to report on their 990 expenses that are not currently required to be reported. Some examples include the use of school vehicles, club memberships, housing reimbursements, and the Access Act will also require schools to report on their 990 more information regarding fees paid to investment advisors, including risk profiles and expected rates of return. And the third piece to this plan is called the PLAN Act, which stands for Promoting Lifelong Accountability Now. Under this act, Mr. Reed is saying that schools should be required to submit cost containment plans to the U.S. Department of Education every 5 years to show that their tuition costs are increasing at a slower rate than inflation. The PLAN Act also says that the schools with a large number of students who graduate on time and are hired within their field of study should also be rewarded. So the idea is that colleges should have a stake in the post-graduation success of their students. It's not entirely clear what these rewards and penalties look like, however, but an example of how a school can be penalized is if the schools get less Title IV funds from Pell Grants or loans. So a quick look at the numbers. According to the National Center for Education Statistics, just to give everybody some perspective, in fall 2016, about 20.5 million students were enrolled in colleges and universities in the United States, and the average price per year for undergraduate education, including tuition fees, room and board, was about $17,000 at a public institution and $42,000 at a private institution. So moving on to other topics of interest, the IRS has issued new guidance related to facilities financed by tax-exempt bonds and provided new safe harbor rules where certain management contracts will not result in private business use. So for facilities financed by tax-exempt bonds, currently there's a limit on private business use, and that limit is 5% of the bond proceeds reduced by issuance costs over the life of the bond. Over 20 years ago, the IRS released Revenue Procedure 97-13, and in August 2016 and then January 2017, the IRS released new Revenue Procedures 2016-14 and 2017-13 that expand these safe harbors originally under 97-13. Now they're saying that any type of reasonable fixed or variable compensation for services under a management contract is allowed with the term up to the lesser of 30 years or 80% of the weighted average expected life of the property. Other requirements include no share of net profits. The service provider cannot bear net losses and may not take inconsistent tax positions, and the qualified user bears the risk of the property loss and must control the use of the property. So other guidance issued include a news release from the IRS where the IRS just wanted to remind non-U.S. citizens who may have taxable income, such as international students and scholars who may be working or receiving scholarship funds, that they may have a requirement to file a U.S. tax return. The IRS also wanted to remind withholding agents, such as universities and payroll professionals, to try their best to accurately file the Form 1042-S, because this may speed up any refunds due to the non-U.S. citizen taxpayers. And then there are also proposed regulations released in June 2016 that clarify rules surrounding the 457B deferred comp plan and provide more guidance on exemptions and when an employee is considered vested. In September 2016, the IRS issued proposed regulations related to the equivalency determination for private foundations in terms of their international grants. So currently, this determination can come from either the opinion of the grantor or the grantee's legal counsel, or from an affidavit from the grantee. The proposed regulation now expanded this to include U.S. CPAs and enrolled agents. This does not include foreign attorneys unless they meet the IRS's Circular 230 standards. And also, this new regulation did away with the safe harbor of relying only on grantee affidavits. So you can still use grantee affidavits to make good faith determinations, but you can't completely rely on it as your only source. Also in 2017, January, the IRS released in question-answer format more information concerning how to depreciate property when leased to tax-exempt entities. One question was about what if a property was placed in service by a taxable entity and then becomes a tax-exempt property, then how is depreciation treated? And another question came up is what if there's a mix a lease of real property and personal property, for example, a building with furniture in it. And then shortly after President Trump was sworn in, his administration issued a memo to all executive departments and agencies freezing new or pending regulations. This is actually not uncommon for incoming presidents because it provides the administration a chance to review pending regulations until new cabinet members are confirmed and they can decide what to keep and what to do away. But this freeze does include notices and revenue procedures, so additional guidance in general might have been delayed. So the AI CPA's EOTRP, which stands for Exempt Organizations Technical Research Panel, they've been working with the IRS on a few issues. They proposed guidelines for how a tax-exempt organization should allocate expenses for dual-use facilities, and they also provided examples. They also drafted suggestions on how to better update and regulate subordinate organizations. One suggestion was to file the Schedule Q instead of the 990N for each entity. And they also reported their thoughts on laws and regulations surrounding donor advised funds, as they've been growing in popularity as a means of charitable giving. Another issue growing in popularity is crowdfunding, such as sites like Kickstarter and GoFundMe.com, where they're internet vehicles for raising money for new businesses, a new idea, or new personal causes. The IRS is asking CPAs to educate the public about tax implications. The IRS has not released official regulations on this issue yet, but they have said that each is a case-by-case basis, and all facts and circumstances need to be considered. For example, money can be treated as equity if it went towards a new business venture, or even a gift if it was a fundraising effort. In general, as far as it being a charitable deduction, the IRS has made it clear that the taxpayer can only get a charitable deduction if it was made to a qualified charitable organization, a 501c3 entity. So donations that were made to an organization, no matter how charitable the cause, if the organization isn't deemed a qualified charitable organization, then it cannot be deducted as a charitable deduction. And then in general, we're hoping for an updated definition of what a patient is for hospitals in terms of calculating unrelated business income, especially in today's world of medicine. What's becoming more popular is telemedicine, where the patients get to interact with the doctors via internet instead of face-to-face. And the gray area about this is that the traditional definition of patient versus non-patient, according to the IRS, seems to be that patients are usually people who physically receive care or treatment at the facility, but with telemedicine, they don't always come to the facility anymore. Usually treatment is done via the computer, so that kind of gets a little bit murky. So what are the members and staffers focusing on in 2017? In April 2016, a Charity Act was introduced. Charity Act stands for Charities Helping Americans Throughout the Year, and it got bipartisan support, so there's a high likelihood of this being reintroduced. Several proposals include a flat 1% private foundation excise tax, an expansion of the IRA rollover to include distributions to donor advised funds, making the standard mileage rate for charitable contribution deductions to be the same as medical and moving expense deductions, a mandatory Form 990 e-filing requirement, and also provides an exception for excess business holdings on private foundations for certain business enterprises. And in order to qualify for this exception, there must be an exclusive ownership requirement, and there's a typo there that should say 100%, not 10%. The private foundation needs to own 100% of the business enterprise during the year, and the private foundation needed to have acquired the business enterprise by will or trust. There's also a profits to charity requirement and an independent operation requirement. And there's the Johnson Amendment that has been in the U.S. tax code since 1954, and it basically prohibits all 501c3 organizations from endorsing or opposing political candidates. The Trump administration wants to appeal and amend this provision and expand regulations on political activities. Bills introduced so far would allow charitable organizations to make statements related to political campaigns if such statements are made in the ordinary course of carrying out its exempt purpose. Which brings us to our last and final polling question.
All right. Our final polling question is, which proposals introduced in the Charity Act are you most interested in? Expanding the IRA charitable distributions to include donor-advised funds as eligible recipients, imposing a flat 1% excise tax on net investment income of private foundations, Form 990, mandatory electronic filing, changing the standard mileage rate for the charitable contributions deduction to the medical moving expenses mileage rate, or having an exception on private foundations for certain philanthropic business enterprises from being assessed the excess business holding tax. I'll give everyone a few more seconds to make a selection. And let's take a look at the results. Jane, back to you.
Thanks. So, yeah, it looks like everybody's interested in a little bit of each of these, which is pretty cool. I think all of these are all great proposals. Interesting fact, the flat 1% excise tax and the mandatory 990E filing was actually introduced before, back in 2014, so I think it's something that they're going to try to eventually put in place. And the last couple slides, as Patty mentioned, it takes us through tax reform, and we won't spend too much time on these because these are still pretty fluid and very unpredictable. But in general, they're looking at 3 different ways of tax reform. First is a temporary tax cut, which might decrease the incentive of charitable deductions, so organizations might be receiving less, who knows. The second might be a base broadening by eliminating deductions, so more income being taxed but with a lower rate. And the third is having a consumption tax, which actually is falls heavily more on the poor because they consume more and save less compared to the wealthy. Other things she's looking at is possible repeal of the estate tax and bringing back U.S. companies by lowering their corporate rates and getting rid of double taxation. And they're hoping to simplify the tax system by making the tax return look like this going forward, which we think is pretty highly unlikely. So overall, very still, up in the air, as Patty mentioned, but in general, looks like his administration's biggest policy objectives seem to be tax reform, healthcare, and infrastructure, and here are more resources for you to look through if you're interested. And that's all we have for today. Any questions?
Great. Thank you, Jane. We actually don't have time for questions today. If you do have a question for our presenters, you can still enter the question into the Q&A box, and we will follow up with you via email. Before I close, I did want to see if we could get the correct answer to the third polling question here. And Patty, did you have the right answer for this?
Sorry,
okay.
I was on mute. It was.
Oh, that's okay.
It's the last one. I was talking to myself. It's the last one, 4.5 months after year end, or 5/15. One extension now to 11/15 of your calendar year. So we're really excited about that. We only have to extend once, and it's nice. It's a nice change.
Great. Thank you. And thank you to Patty and Jane for a great presentation today. Like I said, we covered a lot of material, so we don't have time for questions live, but we'll be happy to follow up with you all after the webcast. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of your slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. And I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 2 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.